Seeing, personally, I'm seeing a lot of new business. I'm seeing a certain amount of refis, and a certain amount of those refis are tainted with the fact that they can't support the same loan balance today, and that they're being either bought down or the other bank is going to say, just find me a new lender and I'll write off $1 million, just please leave my house. And then we've done some of those because they figure for the lower amount, but the lender just wants out.
The first question most lenders are asking today is, why are you leaving? Why are you coming to me? If you're a good customer of that bank or that lending shop, why you need to come to me?
So let me just repeat that the best of my, that's in a lot of words, but the question basically is based on the Deutsche Bank article that came out with 2/3 commercial properties not being refinanceable in the next the coming years as they come due. Are the terms going to change to allow this deluge of potential foreclosures to be stemmed, and if so, what specifically?
The answer is it depends on the bank. If you're within a bank that is struggling right now and is trying to recoup as much capital as possible, you'll probably find a lot of deaf ears in terms of working with people, no matter whether you're a good customer or not. I don't know if you looked at my brief bio, but I come out of probably the poster child for this whole problem, which is Citi. And there wasn't a lot of receptivity even to the good customers while I was there. They were trying to ditch as many as they could in order to recover capital. If you're in a bank, and I'm not doing this as a plug for Signature Bank, but if you're in a bank that's well capitalized and profitable, and you're a customer who's been, who's been loyal to the bank and has kept balances with the bank, and you've done all your banking with the bank, and you come and you say, I want my loan refinanced, even though we have tougher standards, we'll probably do whatever we can to accommodate that customer. Will we get some criticism from the regulators? It's possible, but because we're well capitalized, they give us some leeway.
I think you've got to. There are two different kinds of loans that report talks about. There are loans that portfolio lenders have on their books that may be underwater and need that extra hand, and then there are the loans that are in these conduits that who knows who owns what. It's the conduit loans that create more of a problem because there's no one in charge who owns that or manages it and can make any decision. When those come due, they've got to be paid. And people fooled themselves in some respects by running to those for years. And as a conventional lender, I used to say to my clients, it was like the Roach Motel. You got in, but you can't get out. How are you going to deal with this? And the answer was, they're giving me so much money and it's so cheap and I got interest only for 10 years, I'm taking it. So now they're faced with the problem. They have no one to talk to. So if it's something that's within my own portfolio and the client comes in and says, I've got an issue, I'm underwater, as I say, we can put it on some part of it accrual. We can do all kinds of things. Within the bank, we can write up special reports. We can special mention it. We can take extra reserves against it. But my client will go on and he will be alive and he will be well. The other thing that you've got to look at, that report talks about loans coming due over a 3 or 4 year period. I can see to the end of this room. I can't see out 4 years. So stuff that may have a difficulty today, times we hope will improve, the difficulties diminish over time as our economy improves. So the ones that they're talking about that mature 4 years from now may never hit the skids. But if we look in the short term, the deals that are held by banks that, as Sal says, are well capitalized and where the client has a relationship, those deals will be worked out. The conduit deals, totally different story.
And to emphasize one of Lowell's points is to determine if it's a bank loan, what your bank's situation is, but to the extent it was a loan meant for sale, to figure out if it's in a pool already, And if so, contact your master servicer, who will put you with the special servicer. If it's not in a pool, you may be talking to someone who wants to get rid of that loan and may be willing to get rid of it at a discount. There was some legislation proposed earlier this year by special servicers of CMBS loans to change RENIC law to be able to do extensions. That isn't on the legislative agenda right now, but that might be one possible solution in the future.
I dealt with a special servicer in a situation, in a workout situation, and the gentleman was in some remote place in Texas, and we had a loan, or they had a loan. They were servicing a loan in Brooklyn. The guy didn't know where Brooklyn was. He didn't understand values. He certainly didn't understand where Red Hook was. And I told him, please come up and I'll take you on a tour of Brooklyn. The guy nearly had a heart attack on the phone, you know.
And I think that issue is probably the single biggest issue that commercial real estate is going to have to face, because even though, as Lowell said, some of these loans are 3 and 4 years out, the Real Estate Roundtable in Washington has done a study showing there's about $400 billion of CMBS loans maturing this year. And when the first one of those, where even forget about the non-performing loans, but when the first performing loan matures and the owner has nobody to speak to and can't refinance that loan because of the amount of dollars involved, it's going to be the first domino in a set of dominoes, potentially, with potentially devastating effects for the marketplace. So it's going to be very interesting to see what happens there.
Great. Well, I want to thank my panelists. Thank you for coming today. All of you, appreciate it. And a special thanks to Kennedy Funding for sponsoring tonight's event. I hope you'll have an opportunity to stay a little bit and chat with our guests. And thank you very much. I'm Ryan Slack.
Helps you budget medical costs, and it picks up some of that 20%. Helps you budget medical costs, and it picks up some of that 20%, potentially saving you thousands of dollars out of your own pocket.